International Financial System versus Indian Financial System. We all know that the financial system is possibly the most important institutional and functional vehicle for economic transformation. In this lesson, we will go through international financial system, the international monetary system, the international financial institutions, Indian financial system, the components of Indian financial system, the impact of liberalization on financial institutions and market. After going through this presentation, you should be able to explain international financial system, describe international monetary system, identify the international financial institution, define Indian financial system, describe components of financial system, analyze the impact of liberalization on financial institutions and market. The international financial system has grown in importance as the US economy has become more interdependent with the economies of the rest of the world. The international financial system is the financial system consisting of institutions and regulators that act on the international level as opposed to those that act on a national or regional level. International finance is a distinct field of study, and certain features set it apart from other fields. Features of international finance are foreign exchange risk. For example, foreign exchange is an unexpected devaluation adversely affecting your export market. Political risk. For example, political is an unexpected overturn of the government that jeopardizes existing negotiated contracts. Market imperfections. Example of market imperfection is trade barriers and tax incentives which may affect location of production. Fourth is expanded opportunity set. Example of an expanded opportunity set is to raise funds in global markets, gains from economies of scale. The international monetary system is a set of rules that governs international payments or exchange of money. Historical overview of exchange rate regimes are: first is classical gold standard, pre-1914. Gold has been a medium of exchange since 3000 BC. Rules of the game were simple. Each country set the rate at which its currency unit could be converted to a weight of gold. Currency exchange rates were in effect fixed. Expansionary monetary policy was limited to a government supply of gold. Classical gold standard was in effect until the outbreak of World War I, as the free movement of gold was interrupted. Second is the interwar years and World War II. During this period, currencies were allowed to fluctuate over a fairly wide range in terms of gold and each other. The US adopted a modified gold standard in 1934. During World War II and its chaotic aftermath, the US dollar was the only major trading currency that continued to be convertible. Third is Bretton Woods 1944. As World War II drew to a close, the Allied powers met at Bretton Woods, New Hampshire, to create a post-war international monetary system. The Bretton Woods Agreement established a US dollar-based international monetary system and created two new institutions, the International Monetary Fund (IMF) and the World Bank. Fourth is floating exchange rates 1973. Since March 1973, exchange rates have become much more volatile and less predictable than they were during the fixed period. There have been numerous significant world currency events over the past 30 years. The World Bank was established to help the restoration of economies disrupted by war by facilitating the investment of capital for productive purposes and to promote the long-range balanced growth of international trade. The IMF is primarily a supervisory institution for coordinating the efforts of member countries to achieve greater cooperation in the formulation of economic policies. International Bank for Reconstruction and Development (IBRD) was set up in 1945 along with the IMF to aid in rebuilding the world economy. The International Development Association (IDA) was formed in 1960 as a part of the World Bank Group to provide financial support to LDCs on a more liberal basis than could be offered by the IBRD. The International Finance Corporation (IFC) was established in 1956. There are 182 countries that are members of the IFC, and it is legally and financially separate from the IBRD, although IBRD provides some administrative and other services to the IFC. The MIGA was established in 1988 to encourage equity investment and other direct investment flows to the developing countries by offering investors a variety of different services. The International Monetary Fund works to foster global monetary cooperation, secure financial stability, facilitate international trade, promote high employment and sustainable economic growth, and reduce poverty around the world. ADB is an international development finance institution whose mission is to help its developing member countries reduce poverty and improve the quality of life of their people. Indian financial system consists of financial market, financial instruments, and financial intermediation. The Indian financial system is broadly classified into two broad groups. First is organized sector and second is unorganized sector. The organized financial system comprises of an impressive network of banks, other financial and investment institutions, and a range of financial instruments, which together function in fairly developed capital and money markets. The organized financial system comprises of banking system, cooperative system, money markets, and financial companies or institutions. The unorganized financial system comprises of relatively less controlled moneylenders, indigenous bankers, lending pawnbrokers, landlords, traders, etc. This part of the financial system is not directly amenable to control by the Reserve Bank of India (RBI). The Indian financial system consists of various institutions, markets, regulation and laws, practices, money manager, analysts, transactions, and claims and liabilities. Components of Indian financial system are financial market, financial intermediaries, and financial institutions. A financial market can be defined as the market in which financial assets are created or transferred. It can be further divided into different types of markets. The money market is a wholesale debt market for low risk, highly liquid, short-term instrument. The capital market is designed to finance the long-term investments. The transactions taking place in this market will be for periods over a year. Credit market is a place where banks, FIs, and NBFCs purvey short, medium, and long-term loans to corporate and individuals. The forex market deals with multi-currency requirements which are met by the exchange of currencies. Financial intermediation in the organized sector is conducted by a wide range of institutions functioning under the overall surveillance of the Reserve Bank of India. Financial instruments are money market instruments. The money market can be defined as a market for short-term money and financial assets that are near substitutes for money. Capital market instruments. The capital market generally consists of the following long-term period. Next is impact of liberalization on financial institutions and market. First is impact of liberalization on financial institutions. The improvement of financial health of banks is sought to be achieved by capital adequacy norms in relation to the risks to which banks are exposed, prudential norms for income recognition, and provision for bad debts. There is a need to further improve financial soundness and to measure up to the increasing competition that a fast, liberalizing and globalizing economy would bring to the Indian banking system. Second is impact of liberalization on financial market. SEBI has issued guidelines for primary markets, stipulating access to capital market to improve the quality of public issues, allotment of shares, private placement, book building, takeover of companies and venture capital. There is a sea change in the institutional and regulatory environment in the capital market area. Difference between international and domestic financial system is given in a tabular form. Please go through it. Now let us check if we have understood the various concepts discussed in this lesson clearly. The IDA was established by World Bank to provide financial support to LDCs on a more liberal basis. Right or wrong? Right. IMF lends money to members having problems in meeting the financial obligation to other members. Right or wrong? Right. ADB was established to provide financial support to small and less developed countries. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied till now. Financial system plays a very important role in the growth of an economy. Financial system helps in pooling the surplus money and makes it available where it is needed. Financial markets present three major efficiencies for the sake of development, and they are allocation, information, and operational efficiency. Financial institutions are profit-maximizing businesses that earn profits by acquiring funds at interest rates lower than they earn on their assets. Globalization increases the ability of firms to do business across national boundaries. Money market is the place where transactions take place for short period. Primary market includes the issuance of new securities. Secondary market is a place where existing securities are traded. Call or notice money is used for a very short period. Treasury bills are short-term up to 1 year borrowing instruments of the Union government. Treasury bills are issued for the time period of 14 days, 91 days, 182 days and 364 days. Commercial papers are short-term instruments which are issued by highly rated companies.